News Talk 94.5 WPTI, 96.7 FM WTOB. You're listening to The Wealth Guardians with Doug Ray, helping you retire the job and keep the paycheck. I'm your host, Doug Ray. With me is Brice Payne. Today, we're going to be talking about how procrastination dooms your financial future. Good morning, Brice. How you doing?
I'm doing all right, Doug. Had a tough week here in football season already. I don't think any of the Wealth Guardians teams came through in the end.
My Pirates did.
Okay, your Pirates did.
Packers looked awful.
Packers looked awful. Panthers didn't do too great. Denver Broncos lost in the last seconds. So it was a rough week in the pro teams. On the good side, Air Force Academy met CU, my alma mater, and I used to go to high school on the Air Force ground, so I used to go to those games all the time. So it was a win-win for me there. One of my teams was going to win. Air Force Academy you might see them ranked in the next couple of weeks because they're going to keep winning. The rest of their schedule's pretty lax. But boy, I sure hope good games out there. If they're not, but not the Wealth Guardians teams didn't win. All right.
Brice, before we get going here, I just want to say a big shout out and a thank you to our audience out there. If it weren't for you, we wouldn't be on the radio. And this month, starts the Wealth Guardians radio show's 16th year on air here in the Triad. So thank y'all very, very, very much.
Happy birthday to us. Happy anniversary to us. Very good, Doug. Well, before we get started on the show, Doug, you said we're going to be talking about how procrastination dooms your financial future. What keeps our future bright and cheery is all the men and women in uniform out there who put on that uniform and fight for this country. And as always, we want to do a Wealth Guardian service salute out there to all our first responders and our men and women in uniform and their families for the sacrifices that you make for this country. So thank you very much. Doug, thank you for your service. Garrett's over there in the background. Garrett, thank you for your service as well. And all right, say that. We say it every week here, and we mean it from our hearts. So, Doug, let's talk about how procrastination dooms our one's financial future. You know, people have many reasons for procrastinating when it comes to putting a retirement plan together. And what we're going to do is explore some of these excuses that we've seen come through here over the years and why they can be dangerous and talk about how to overcome them. And Doug, let's get started on this list here. And one of them is, we'll cut right to number 2 here. I don't know who to listen to. We hear that a lot.
Yeah, you hear that quite a bit. And, you know, let's face it, in this day and age, I mean, we're bombarded with information. I mean, you can turn anywhere you want to and get just about any opinion about anything.
That's true.
So I can understand how that's confusing, but it shouldn't put your planning off, because think about this, folks. Your retirement planning, you've worked all your life for this. This is your golden moment. And if you don't go into retirement with a good, solid plan, then you're just chancing that the rest of your life may work out or it may not.
Right, absolutely. So, if we gave somebody a bit of advice on that, say, I don't know who to listen to. Well, let us tell you who you should listen to. When it comes to retirement planning, the first thing that you want to look for is somebody who's a fiduciary. Plain and simple. We're fiduciaries here. If you don't know what a fiduciary is, it simply means that person is obligated on the professional level to operate on your best interests. They cannot take into consideration what might be in their best interests. Half of advisors out there are not fiduciaries, or they're not obligated to act on the fiduciary standard. So find yourself a fiduciary. And I would also say, if you're talking about retirement planning, find somebody who has the Retirement Income Certified Professional accreditation. Doug has it. I have it myself, and it's a key accreditation to have when you're doing retirement planning. So if you found somebody with those two things, it's a pretty good bet that you be safe to listen to them. All right, Doug, let's go to the next one. Dealing with financial stuff stresses me out. Yeah, that's my wife. for one thing, so it's a good thing that I married her. But yeah, dealing with financial stuff stresses a lot of people out.
Yeah, some people have that phobia.
Yeah.
And
it doesn't mean that the problem's going to go away.
Yeah, I'm thinking of one in particular, and she's a dear friend. But you gotta get past that because your future's coming whether you want it or not.
Yes.
So, yeah.
Yeah.
It is a stressor for a lot of people, but I think you and I and Garrett, we kind of help ease that stress as they come through our process.
I know that we do because people have come to us, and sometimes it's the husband bringing the wife along, or it's the wife bringing the husband along. One of them's always a little bit more enthusiastic about going through this process than the other one. But we get a lot of feedback in the end that, I'm really glad that I sat down with you guys in the end. This wasn't nearly as bad as I thought it was going to be.
Yeah.
I feel so much better now that we've gone through this process. They might not have realized how much stress it was causing them not doing this or avoiding going to a financial planner. But in the end, the majority of the feedback that we get is, I'm really glad that I came and sat down with you guys.
I talked to a young man this week who is considering coming to us for a second opinion, and one of the things he said, please don't hard sell anything. And I just said, that's never our way we do business. I said, you're not buying a timeshare from us. I mean, you're going through a retirement planning process. It's educational event,
right?
So
right.
He's going to start, I think, next week. So that's a good thing.
Yeah, we provide you with information when you sit down with us. If you want to sit down with us, you can reach out to us. It's 336-391-3409, 336-391-3409. You can also reach out to us via the interweb, and our website is thewealthguardians.com. We don't bite. We try to do the best to take what is normally a stressful topic and make it as helpful and beneficial and non-stressful for you as possible. Like I said, that's the feedback that we get. We can't reach out to you. You've got to reach out to us. But we get very few people who come through here and say, boy, I wish I hadn't gone through this. I don't know the last time that somebody said, I don't think it was worth my time to have come and sat down with you guys. That's never the feedback.
Happened.
Never the feedback that we get. If you're just tuning in, you're listening to The Wealth Guardians, and we're talking about procrastination and how it dooms your financial future. So, Doug, let's move on to the third one here. I'm too busy.
Well, I'll tell you what. Again, yes, I'm busy too, but I don't like going to the doctor. But my goodness, I go to the doctor. It's in my best interest for my future, and so is your retirement. Again, it's all about your retirement. You may be sitting there thinking you're going to retire in 5 years or 2 years, but what happens if tomorrow morning you go into work and you get retired? Are you ready for that? Well, I would tell you it's time for you to find out if you're ready for retirement. Take the time. It's very important. Now, granted, our process is thorough. It demands time on your part. There's 4 meetings involved. So you're going to have to come prepared to give us about 5 to 6 hours of your time. And we'll stretch it to more meetings if you need it. But it's thorough, and I promise you this. You will know by the time you complete our process if you're ready for retirement.
And, once in a while, there is somebody who says, somebody comes into us, they give us what their thoughts on retirement are, and they want to retire maybe in 3 years. On a very rare occasion, we might say, sorry, that's not going to work out. You're going to have to work for 4 or 5 years. For every one person like that, there's 10 people that come through our door that they say, well, I would love to be able to retire in 2 years, but I don't think there's any way I can. And we go through the process with them and show them, yep, you absolutely can retire in 2 years. In fact, you would probably be okay retiring tomorrow if you really wanted to.
That happens a lot,
That actually happens a lot. And the relief that somebody has when they hear that news, that's one of, Doug, I know that's one of the main reasons that you love this job is because of a moment like that when we tell somebody that they can retire, they've done a good enough job saving for retirement. It's just such a good message to be able to give to somebody. And I'll ask you out there, if you're wanting to retire in 3 years or so and you're not sure if you can, and it turns out by the numbers that you could retire in 2 years, would you rather know that now, or would you rather know that after you worked 3 years?
Yeah.
And, hey, you could have retired 2 years ago. Really? I don't like my job. I would have loved to have known that. The only way you can know that is if you sit down with a financial planner.
Think about that, folks.
All right, let's try to get one more in here, Doug. I don't know where to start. Where would somebody start? We get that a lot.
336-391-3409. That simple.
You missed a step there. You got to pick up your phone.
Yeah.
And then you dial that number, 336-391-3409. That's where you start, by sitting down with a fiduciary financial planner and answer the questions that they ask you, and they'll start providing you with the information. That's what we do here, day in and day out, week in and week out. All right, Doug, that's starting to wrap up our first segment here. We're going to come back after the break for our second segment, but we always do something before the break. What is that?
Oh, golly, a trivia question.
Oh, trivia question.
Yes.
That's right. It's time for the trivia question. Now that Doug's back, he took a couple weeks off. Let's see if we can stump Doug. Doug, I'm throwing you a softball here. On the 16th anniversary of the Wealth Guardians radio show, I'm going to throw you a softball here. Get your bat ready. All right, Doug, on September 15th, 2008, this company filed for bankruptcy, and this became the largest bankruptcy in U.S. history.
Okay.
What was the company? That was a confident okay that we just heard from Doug right there. He knows this answer. Let's see if you know the answer. Stick with us. We'll be back after the break. This is Brice Payne. With me is Doug Ray. The show is The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB. News Talk 94.5 WPTI. 96.7 FM WTOB. You're listening to The Wealth Guardians with Doug Ray, helping you retire the job and keep the paycheck. I'm Brice Payne along with Doug Ray, and thank you for sticking around through the break. This segment, we're going to be talking about going against the grain. Going against the grain. Now, I know you stuck around through the break because you want to see if we stumped Doug and you want to see if we stumped you, and we are going to get to that trivia question answer here in just a minute, but before that, I've got a question for you. Are you looking forward to your retirement? I would hope that you answered yes to that. Do you want to confirm that you're making the best decisions for your retirement? I certainly hope you answered yes to that. Well, then Doug, Garrett, and myself, we've got good news for you. We offer here at the Wealth Guardians a no-cost, no-obligation second opinion/review of your current portfolio and financial situation so we can see how we can help you retire the job while keeping the paycheck. We're fiduciaries, we're financial planners, and we're retirement income certified professionals here at the Wealth Guardians. And if you want to reach out to us and go through a planning process with us, you got to pick up the phone and give us a call, 336-391-3409. 336-391-3409. All right, so let's get to the trivia question. Let's see if we stumped Doug talking about going against the grain. I don't normally throw softballs out here, but we hadn't seen Doug here in the studio for a couple of weeks. I wanted to welcome him back with open arms, so we threw him a softball. Doug, on September 15th, 2008, this company filed for bankruptcy, and this became the largest bankruptcy in U.S. history. What was the company?
Yeah, you know, that was such a tumultuous time for the financial services industry. I remember it like it was yesterday. In fact, this show, the Wealth Guardians radio show, had turned just about a year old then when that event happened. And my co-host at the time, Brian Geiser, who now has his own radio show, we were live back then on Saturday mornings at 8:30, and Friday evenings is when the Fed would come in and close down the banks. So we would read out this list of banks that got closed.
Fun times that was.
Yeah, it was something else. But your answer is Lehman Brothers.
Oh boy, we've not heard that sound here with Doug in the chair in a while. That feels good. Garrett got that sound a lot, by the way, in your absence, Doug. But absolutely, it was the Lehman Brothers. They were the fourth largest investment bank in the U.S. They had $600 billion in assets at the time, and of course, they fell victim, as many investment firms did at the time, to the subprime mortgage market. They had been in operation for 164 years.
Oh, it was like the shot heard around the world.
Yeah.
You know.
They started as a dry goods store in Montgomery, Alabama in 1844 by Henry Lehman, who was a German immigrant. And then his brothers came over and joined him, and they became the Lehman Brothers, and they expanded into cotton and commodities trading and moved over to New York. So you go from a grocery store to one of the fourth largest investment banks in the world. That's pretty good. Unfortunately, they got caught up in some bad decision making around those subprime mortgage. There's a little joke, if you ever have watched the Despicable Me movies. In the very first movie, the character is walking into a bank. He's an evil guy, and so he's walking into the Bank of Evil, and it says underneath, formerly Lehman Brothers.
Yeah. Well, to go into trivia, it wasn't a couple weeks later that we lost Wachovia. A week after the chairman of the board went on Jim Cramer's show and said, "Hey, Wachovia is great, strong, and powerful," it went under the next week.
How about that?
Yep.
Can't always believe what you hear on the radio. I know that sounds, you wouldn't believe that if somebody told you, but you can't always believe what you hear on the radio. What you can believe is what we're about to tell you, and how going against the grain, sometimes financial advisors do this. So being a good advisor isn't about winning a popularity contest or just saying the same thing that everyone else in the industry says. It's really about giving the best advice that you can for each individual situation. So in this segment here on today's show, we're going to peel back the curtain to discuss some areas where a good financial advisor's opinions might go against the grain with mainstream ideas in the industry. So Doug, let's peel back this onion here. The appropriate amount of risk for a retiree or pre-retiree.
I am really glad you brought that topic up, and I am so happy that when you came aboard almost 5 years ago now, we started doing risk assessments of the portfolio and risk tolerance test. We talk about our process and how thorough it is, but this is just one little piece of that overall process. And what we've discovered since we started doing this is people's portfolio has way more risk in it than they ever knew or can tolerate. We score the risk on a scale of 1 to 100.
We use a software called Riskalyze, third-party software.
Exactly. And a lot of these portfolios are coming in rating around a 60 to a 65. The S&P 500 is a 75, folks. That's the market. Yet when we do the risk tolerance test, they're down in the 30s to mid-30s. So
which is where they should be. If they're planning for retirement.
But way out of sync with their portfolio.
And what happens is that somebody has had that same portfolio for more or less 10, 20, maybe even longer years. And 10, 20 years ago, retirement was a ways off for somebody. So their risk tolerance was up there in the 60s or 70s, and it was appropriate for it to be there at that stage of the game in most cases. And so for their retirement portfolio to be up there in the 60s or 70s, okay, no real problem at that stage of the game. But the closer they get to retirement, their risk tolerance year by year is dropping and dropping. But they never adjust their portfolio to accommodate their lower risk tolerance.
Yeah, they didn't, their advisor didn't, and that's a shame.
So if you want to sit down with a financial planner who uses software like this, you can give us a call, 336-391-3409. I've said it before, I'll say it again. There is no cost or obligation to sit down with us other than your time and gas money to get to our offices. And like Doug says, risk tolerance and risk analyzing, assessing those is just one of the key aspects of our full holistic retirement plan process that we have our clients go through. All right, Doug, the next one, the appropriate use of life insurance. You've been working with life insurance for longer than I have. We both got our licenses, but what would be an appropriate use of life insurance for somebody who's retiring?
Well, there is no one fixed number, if you will. Everybody's different. Some people have a great need for life insurance. Some people really probably don't need it. You get mixed opinions from advisors. There's a nationally syndicated radio show right now that, this very famous advisor, who I like a lot, but he swears against permanent type life insurance. He's all about term. Term is very appropriate when used properly. But, with modern day life insurance, you can craft your long-term care program around that too. And that's beautiful because the old long-term care is built like your automobile policy. If you never go out and wreck your car, then you've wasted all those premiums. Same is true with long-term care. If you never use it for home health or nursing home, you've wasted all that money. But if you craft it around a permanent structured life insurance policy, then you're going to use it one way or the other. Either you're going to use it for care, you can pull cash out of it if you ever need it, or if you go through life and never touch it, then somebody's going to get a tax-free death benefit.
There you go. So as Doug says, it really depends on your situation, depends on how old your kids might be, if your wife is self-sustaining or your spouse is self-sustaining, if you've got a mortgage. So there's a number of different factors that a financial planner would help you consider and weigh the need of life insurance for you or long-term care insurance and the type of that insurance. All right, Doug, let's move on to the next one. How to handle debt.
Yeah, you know, a lot of times people come into retirement and they've got a hefty mortgage and that kind of thing, and that just makes the retirement planning process a bit tougher. You know, when you come into retirement and you're debt-free,
that's half the battle.
That's more than half the battle, I think.
Okay.
But yeah, handling debt, you know, our society now is me want it, we get it kind of a society, and put it on the credit card. And unfortunately, from what I've been reading with this inflation, more and poor people are putting necessities on their credit card, and they're piling up debt.
That's a scary situation, especially when the Fed is raising interest rates right now. That just means the interest rate on your credit card is going up as well.
And that's a variable rate loan, folks.
There's some good debt out there. There's some really, really bad debt out there. And we do get the question, we've been working with some clients right now. They had a little bit of credit card debt. They have a truck payment, and they've got some hospital debt from a unplanned emergency that happened. And her intuition of what to pay off in what order was a little bit off from a number standpoint. So we kind of had to re-educate her. Look, I know that you really want to take care of this mortgage payment first, but that's your lowest interest rate. Let's not tackle that one first. And your hospital debt. I know you don't like having the hospital debt, but they're not charging you any interest rate on that. Let's backtable those and work on this smaller credit card debt and the truck payment first. All right, so that's just how debt should be handled. Let a financial planner talk to you about that, and have them give you a professional's thought on that before just going and paying your mortgage off early. If you've got a low rate mortgage, I don't know that should be your number one concern when preparing for retirement. Doug, the next one we want to talk about is, since we just covered the whether or not to pay off the house, let's move to the next one. Appropriate use of annuities, the A word.
Yeah, you know, again, that's a misconception of an asset class. There's a lot of advisors out there who will tell you don't ever buy an annuity. There's a lot of things in print and on the internet that's misleading about annuities. You know, we use them as a bond replacement tool, but we use one particular variety of annuity. You know, I think the word annuity has gotten a bad rap from one particular type of annuity called the variable annuity. It is expensive. It has all the risk of the market, and it has all the upside potential of the market because you've got mutual funds in that thing. So don't let the A word, annuity, scare you away. When, like any other investment financial tool, when used properly, it's okay. On the other hand, you don't want to have an advisor want to put 95% of your investment funds in an annuity.
Never do that.
That's not appropriate. And I've seen advisors try to do that.
Yes, we have. We've come across that, and no shortage of them. So just as you said, Doug, there's a variable annuities. Those offer you no downside protection. There's fixed annuities. Those are a lot like CDs. It's a predetermined rate of return for a predetermined amount of time. And then there's fixed index annuities, which can be, as you said, in this market conditions at least, a decent replacement for bonds in some people's portfolios. Well, Doug, so we've covered just about everything that we needed to in this second segment. What we haven't covered is, do we think the Panthers are going to win this week? Oh, boy.
I think they're going to come back.
Okay. All right. Very good. Well, we'll leave it on that happy note there. This is Brice Payne. With me is Doug Ray. The show is The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB.